In the words of the cast of a film known as The Room, stock in PayPal might, at the moment, be just a little bit cheap, 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 cheap. So, PayPal is at some of the lowest lows it has been at in years and years. Last fall, it got close to current levels, but recently it dipped below $60. It's hovering right around that $60 mark right now. It had achieved highs of over $300 at one point in time. $308. Wow. 80% fall in this stock. If you caught my live stream, you know that I feel like this is a prime example of irrational highs followed by irrational lows. What do the financials say? Well, PayPal is a fast-growing company. All right. Now, the growth had possibly a little bit of a bolus to its growth during the COVID times, 2020 and 2021, and then it slowed down dramatically in 2022. Now, a lot of companies had a surge in growth in these years and then actually lost and had negative growth following. So I think it's pretty impressive that not only did they maintain those new heights that they had achieved, I mean, for a company that was already the size of PayPal in 2020 to grow 20% and then, pretty darn close to that in 2021 is pretty impressive. Because before, you would have thought, hey, 2017, they got up to 20% growth, then it fell to 18 and then 15. A continuation of that, you would think would have been maybe something like, 13 or 14 in 2020. Instead, it was probably better than what people might have been expecting. Hence, probably why, from there on out, it kind of rocketed up to those really nosebleed levels in value. But, with 2022 being still, a decent amount of growth, like I don't thumb my nose at 8 or 9% growth in a company that's doing 25, 26, 27 billion dollars of revenue, okay? So PayPal, it slowed down last year pretty substantially, but the crash in stock price that followed was just redonkulous, okay? Now, it could be due to, EPS taking a bit of a hit, but the interesting thing is that free cash flow actually stayed pretty consistent, but net income and EPS did take a hit in 2021, 2022. That's interesting, but since free cash flow had stayed consistent, they're still bringing in, essentially the same amount of cash into the company. I would still maybe want to understand a little bit more about exactly what led to the drop in EPS and net income, but I would imagine that as time goes on, these numbers will probably converge again into the future, and I would trust the number that's been more consistent over the last 3 years to put into a pricing model more so than the one that suddenly dropped, right? Now, they also, let's take a look at the balance sheet real quick. Okay, they've got a good amount of cash on hand, good amount of receivables. Total assets outweigh total liabilities by a good amount. So, yeah, they're doing okay. Doing okay. Oh, you know what I wanted to look at? I wanted to look also at their gross margins because I want to bring that up later. Okay, so their gross margins are usually in the upper 40s, mid to upper 40s, at one point lower 50s. Wonder if they can get back to there. But lately, a drop to the low 40s, 42%. Operating margins usually 15-16%, dropped below 14%. Okay, and profit margin, bottom line margin, went from near 20% down to under 9%. So that's pretty rough. Free cash flow margin stayed pretty, reasonably good. Only went down to 18.5%. Gosh, I really wonder what drove that specifically, but either way, some assumptions that I threw into the calculation on this company. So let's say we want a 12.5% return on this. What would need to happen for the next 10 years is for them to achieve 9% growth. Now, the default would have been 17.7 if we wanted to duplicate the previous 10 years. However, I think the signal that I'm seeing in their financials shows me they probably aren't going to duplicate the previous 10 years in terms of growth. Okay, you saw that the revenue dropped. Now, they could do some work with their margins and such. Granted, get them back up to previous levels and so forth, but that's not a guarantee, right? So I want to drop the growth down to 9%, almost cut it in half. And then, for the terminal stage, I think long term, something in the mid single digits thereafter is probably somewhat reasonable. It could be 5%, it could be 4%. And a discount rate, again, 12.5%. So this is my desired annual return. Give them credit for the $7 per share of tangible book value. Add that to it. And you've got a discounted free cash flow fair value of $66.85. This is the reason why last fall, when it dropped below $70, I was starting to sell puts in the mid to upper 60s, simply because I thought that was pretty close to where the long-term value would be if I wanted a slightly better than market return on this company. Now, I'm going to do something else that I did a little bit on my live stream, okay? What gets you to $300 per share? What kind of assumptions? Just to show you how ridiculous and irrational the market is, okay? So if you want a 10% standard return, or heck, let's say you're happy with a below average return, like something slightly below what you might be able to get with, S&P 500, right? S&P 500's return over the last, say, 40 years or so, I believe, has been 10%. Let's say you're happy with less than that. Let's say you're happy with 9% on an individual stock for some reason, okay? Okay, well, if you're happy with 9%, you actually could justify, with my growth assumptions, up to $87 a share for this company. But it was trading at $300. So what kind of growth for the next 10 years would we need to justify that? Well, what if we just matched the last 10 years? That only gets us halfway there with a 9% return. Okay. Well, what if we get 20% growth in our free cash flow? Well, that doesn't get us there either. How about 22? No. What if we bump up the terminal stage a little bit? It'll be 22 on average for the next 10 years, and then 6% thereafter. By the way, the size it would be after doing 22% for the next 10 years would be astronomical based on the size they already are today. That only gets us to $210 per share. Okay. What if we just bump this up to 25% and say it goes at 8% after that. Well, that only gets us to $273. Okay. We literally have to assume, for those previous high highs to be justifiable, something like 26 to 27% growth for the next decade. So an acceleration over the previous 10 years. And then after that boom period, they would have to continue to do 8% growth. The most recent financials to me seem to suggest we're probably looking at something closer to the 8 or 9% growth for the next few years. Okay, so the chances of this happening are exceedingly small, and it's just that most market participants were just simply too stupid to see that in the moment when it was inflated to the $300+ price, and they were just assuming that growth would accelerate. Maybe they were assuming that 2020 acceleration would just continue and it would get higher and higher every year for some reason. I don't know why, but as a business grows more and more, pulls in more and more revenue, captures more and more market share, the difficulty that it takes to keep growing gets higher. Once they've gotten a certain amount of customers, the cost to acquire a new customer gets higher. That is just the way things work. You need to keep that in mind when you're deciding what price to pay for a stock. Remember, you can pay too much for a great company. I think this is a great company, but I think you have to pay a price that makes sense based on how much income it will produce in the future. If you don't do that, you might as well just say price doesn't even matter. And at that point, what are we basing anything off of? What if price doesn't matter? What determines what's a good investment versus a bad investment? You can find, decent, fair, or even, kind of lackluster companies that still make a profit and maybe get them for a multiple where you'll get an outsized return. It's really the price you pay is what really determines the long-term appreciation and return that you will get on your investment, okay? Please keep that in mind. Price absolutely matters. The market is not particularly rational nor efficient in my personal opinion. Let me know what you think in the comments below. Is PayPal a cheap stock today? What would you pay for it? Do you have any shares of PayPal? What was your cost basis? Throw it in the comments below. Feel free to join me on Discord. I'll put the link in the description. And like the video for that YouTube algorithm. It really helps me out. Take it easy, everyone, and have a wonderful holiday weekend.